So we had an election, new ideas, new policies. Question: how's the stock market reacting so far to the new administration? Well, we take a look at the different sectors representing the S&P 500, and we're measuring the performance starting the day after the election to present date. And we can see here non-energy minerals, that's down almost 9%, while industrial services are up 8%. By the way, we're going to define each one of these sectors and tell you what it means for you. Communications down almost 8%, finance up 6%. So we take a look at the different sectors, each one represented with a line. And again, this starts the day after the election, and we can see for the most part they move together. However, there are some outliers. On the top, the two strongest performers, finance and industrial services. At the bottom, non energy minerals and communications. Well, what are these? Finance, well, it's obvious. Citibank, Goldman Sachs, Morgan Stanley, JP Morgan, and many, many others. Industrial services, that's companies like Waste Management, Baker Hughes, Halliburton, Schlumberger. Also, we could consider these oil services. Non energy minerals, these are the metals, FCX, Newmont Mining, NUE, WI, and communications. We all use them, AT&T, Verizon, T-Mobile, etc. So these are the different sectors that represent the outliers, the strongest, finance and industrial services, and the weakest, non-energy minerals and communications. And we can see there is really quite the divergence between the two. Now, the question is, why is this happening? What factor from the new administration could benefit industrial services and finance while at the same time suppressing non-energy minerals and communications? It's actually a trick question. It has nothing to do with administration. The primary factor or force that has been driving markets over the past month or so, rising interest rates. Now, we're not talking about Federal Reserve interest rates. We're talking about the bonds, specifically the 10-year U.S. Treasury that has moved from a little over 4% to almost 5% yield in the past month or so. This has been a tremendous move up in fixed income treasury yields. Now, industrial services, they have solid balance sheets, and there's a shift in capital allocation under a high interest rate environment for more stable returns, and these type of companies tend to benefit. Now, again, I know the Federal Reserve's cutting interest rates, but the rise in fixed income treasury yields, like the 10-year bond, almost at a 5% yield, that has helped move capital into the industrial services. Also, finance. Banks can lend at higher rates. The banks actually like higher interest rates because it creates larger spreads. We talk oftentimes about the mortgage spreads, and other financial instruments. Banks like to have those options. Now, to the downside, non-energy minerals. There's a high capital expenditure and increased borrowing costs for these type of, the miners, things of that nature. And then we talk about communications. They carry substantial debt, increased cost of debt servicing, etc. So for that reason, the communications companies, they don't really benefit from a high interest rate environment. Also, think about it. When we go to buy a new smartphone, it's more than $1,000. That's financed. That financing becomes more expensive with higher rates. Now, how about stocks and bonds? How are they moving together or not? Well, the different sectors we know have been represented here with the different squiggly lines. That white line represents a 10-year U.S. Treasury bond. And what you'll notice, a very interesting opposite or negative correlation. When most of the stocks go up, that's under a condition where the 10-year bond yield goes down. And conversely, when 10-year bond yields rally, then stocks tend to sell off. We've spoken about this recently, this dynamic between the two. And what is happening very simply is that the 10-year bond yield is moving up under the anticipation the Federal Reserve will not cut interest rates. Now, the economy looks strong. Okay, the numbers look good. But it's the real primary driving force is the expectation the Fed will not cut interest rates. And lately, stocks don't like that. Now, I know sometimes we see these indices at new highs, but they're very, very heavily skewed based on the Magnificent Seven and the giant cap stocks. Now, speaking of which, economic calendar, this week coming up, we have a lot of really big news. New home sales, durable goods Case-Shiller Home Price Index, advanced retail inventories, wholesale inventories, and then a Fed decision on Wednesday. And then wrapping up the week, gross domestic product, pending home sales, and the personal consumption expenditure, among other things as well. When we see each of these news events released, take a look at the 10-year bond yield and remember the narrative we spoke about last week, where when yields rise, there's the expectation the Fed will not cut rates or they're further away from moving rates down. And stocks lately, they don't really like that. We hope this has been helpful. We look forward to seeing you back soon.